So let's talk about the real estate professional strategies first, and then we'll go back and talk a little bit about passive and active strategies. So real estate professional strategies allow you to take the maximum deduction on your cross segregation studies, right? So that's an awesome advantage. You can everybody, passive, well, not passive, active and real estate professionals can both do 1031 exchanges, right? Passive investors can do 1031 exchanges, but typically they're going along with the entity they invested in as part of the exchange. They're not actually doing the exchange themselves. They're kind of just, the operator on their investment, whoever they invested with, is doing the exchange, and they're just electing to go along with it, right? But active and real estate professionals can all do 1031 exchanges. We'll talk a little bit about that. Real estate professionals can maximize their deductions against their ordinary income, right? So let's say you have a lot of ordinary income from your brokerage, say, or from your rental properties or something, and you can say, well, look, I've got a lot of income this year. For whatever reason, maybe I have a lot of income because I did something special that year. Something happened, I sold a property, right? Or something occurred, I got a big commission on something, right? So now timing is everything. Now, so we talk to clients about, when we do tax planning, we talk to clients about timing. Hey, I just made a whole bunch of money, like in the example I gave you before. What can I do, right? And well, do any of your properties need any major repairs? Let's do them before December 31st. Why? Because it's more beneficial to expense repairs in a year where you have high bracket income than it is when you have a year where you have low bracket income. So it's better to take 300,000 down to 250 than it is to take 50 down to zero. Why? Because there's a difference in the bracket, right? One bracket, the higher bracket, you might be in the 25 or 28% bracket, right? Going to 50 to zero, you're in the 10% bracket, right? So you got some tax savings, but that 50 saved you 5, whereas it saved the person that went from 300 to 250, it might have saved them 12 or 13, right? Instead of 5. So there's a big difference. So you always want to try to time and maximize deductions in the years where you have the highest income, right? So another great way to reduce your income is with retirement plans, right? Now, think about this. For passive investors, this is what I tell passive investors all the time. Maybe you can't deduct the rental losses that are coming through on your K1s, but you can use the cash flow you get from them to fund your retirement plan, right? And that becomes a tax deduction, right? So if you're at a W-2 job and you're not maxing out your 401k because you live on most of your money, right? Well, then when you get your distributions from your passive investments, maybe you can't deduct the rental losses, but you can use that to put into your 401k and maximize the deduction you get on that, right? Same thing with active investors, right? Like, so one of the things, when I have an active investor that's close to that $150,000 threshold, right? So I had a client had $160,000 of rental income, or not of rental income, $160,000 of taxable income, right? So now they're not allowed to take their rental losses, right? Well, I said, wait a second, did you fund your retirement plan? No, I haven't. All right, well, let's make a SEP contribution of $20,000, right? That SEP contribution is going to reduce your income from 160 to 140, right? And now, so the way the phase out on rental property losses works is you lose 50 cents for every dollar that you so if you have at $10,000 less, 100. If you're at 140, you can deduct $5,000 of rental losses, right? If you were at 100, you could deduct the whole 25, but at 140, you're allowed to deduct 5. So what did you do? By making that $20,000 retirement plan, not only did I reduce my income by $20,000, but I also got $5,000 of rental losses, So that's like a double whammy. I spent money twice. I got two tax benefits, right? So instead of getting a $20,000 tax benefit, I actually got a $25,000 tax benefit, right? So you always got to look, as an active investor, you always got to look at what can I do before the end of the year that's going to take my income back below, if I'm close, take it back below 150,000 so I can take advantage of my rental losses, right? And we're going to talk about this a little more in depth in a little bit, but we're also going to talk about S corporations versus LLCs and what makes an S corp a better vehicle for not only real estate professionals but for active investors also to use an S corp when they're running a real estate business like flipping houses or brokerage or home building or development. Okay.